Thank you so much for the introduction. Good afternoon, everyone. Hope everyone had a great lunch. Bitcoin, what an asset class it has been. If we take a look back more than 10 years ago, it was trading at almost nothing, just a few $100s. And now it has a market cap of more than $2 trillion. And literally everyone is talking about it, be it like institutions, asset managers, family offices.
I don't think it's on. I don't think I can hear.
You guys can hear me, right?
Yeah, okay.
All okay now? Yeah, you guys can hear me? Perfect. Yeah. So yeah, I was talking about Bitcoin as an asset class. That what a fantastic journey it has been in the last decade or so for the asset class. I mean, starting at just a few $100, and now a market cap of more than $3 trillion. So it's a hell of a journey for sure. But that was about the past. What we need to do is we need to discuss the future of Bitcoin, and there are different angles to it. I hope I had a crystal ball myself to predict the future of Bitcoin, but unfortunately that's not the case. But I do have a bunch of experts who can shed some light on different angles for sure. So without further ado, I would like to proceed with introductions, please. Introductions, yeah.
Hi, I'm Richard Hodges. I work for Furrow Capital and for CAAN. We manage about $100 million of Bitcoin options volatility, and we trade a statistical arbitrage strategy.
Jeremy?
Yeah, hi everybody. Jeremy Dreier, CBDO at GoMining, as well as Managing Director at GoMining Institutional. GoMining, we are the world's largest retail platform for tokenized Bitcoin mining. We have successfully tokenized ownership over hash rate. So just to kind of quickly explain it, we buy and run data centers for mining Bitcoin, and then we've tokenized the mining power that is created in that data center, and we've put that into a digital miner format that is purchased then through our app. The user that purchased the digital miner then receives the Bitcoin from our data centers. No different than if they were mining Bitcoin themselves. The platform now is expanding more into a Bitcoin ecosystem platform, allowing users to earn on Bitcoin, lend Bitcoin, use Bitcoin, because we need to move past the old digital gold area of Bitcoin and get into the actual use case of Bitcoin. So we're going to continue to expand that platform going forward.
Aydin?
Hi, my name is Aydin Kilic. I'm the president and CEO of HIVE Digital Technologies. We're a global Bitcoin miner. Over 2% of the network globally. We mine over 9 Bitcoin a day. We have operations in Sweden, Paraguay, and Canada with about 440 megawatts. And all of our energy is hydroelectricity. We're publicly traded on the NASDAQ, the TSXV, as well as the Frankfurt Stock Exchange. Moreover, we're doing about $20 million of annual revenue in AI compute. We're an NVIDIA cloud partner. But we're here mostly today to talk about Bitcoin and Bitcoin mining. HIVE's actually the first publicly traded crypto miner ever. We went public in September of 2017. So we've been through 2 Bitcoin halvings, an Ethereum merge, and we also built our own ASIC miner with Intel in 2022. So yeah, that's the high level.
Thank you. Good afternoon. My name is Michael Ashby. I am the CEO and CIO of Algoquant. We are one of the largest multi-manager platforms in digital assets. So what does that mean? We basically are a quant platform, and we have about 27 managers. And we are one of the larger trading platforms. And so we were born out of a large Bitcoin family office and run about $500 million in AUM. Thank you.
Well, thanks for the introductions. Michael, you have previously have background in .72 in the hedge fund world as well. Now we are seeing tons of hedge funds, asset managers, family offices, high frequency trading firms getting into Bitcoin trading. In your opinion, in the Bitcoin investment world, where are the opportunities to generate returns?
Yeah, that's a good question. So I'm sure everybody here is aware of what happened a few days ago with the rather interesting weekend, or lack thereof. So I guess I'll start there. There's still a lot of institutional build that needs to happen. It's a very young space, and you see that with most of the trading teams being quite small. The strategies in traditional finance tend to be quite capacity large, but alpha poor. In crypto, it's the opposite. So you have small capacity, but lots of alpha you can make. So what that means is that most of the teams are 5, 10, 15 people. When you have trading teams that are that small, you can't expect them to have large risk management, compliance, technology departments. So what happens when a glitch in the system, like we saw last weekend, everybody gets wiped out. And I think what we're going to see over the next sort of 6 to 12 months is the bigger firms get bigger, and the infrastructure will have to get more robust. And so, it wasn't 9 months ago we had a similar incident with another exchange that was hacked. We don't have these kinds of incidents in traditional finance, and so I think to answer your question, what we see happening is that some of the larger firms will enter, some of the smaller firms will join larger firms, and volatility, although it's at all-time lows, will continue to sort of move into DeFi and tokenization.
And Aydin, taking a different view from the fund management side, help us understand, because you come from Bitcoin mining background, how feasible is Bitcoin mining these days in today's world?
Yeah, Bitcoin mining is industrialized industry right now, in the sense that, for example, to bring on our expansion in Paraguay, we developed 300 megawatts of green energy Bitcoin mining. We deployed about $400 million US, and that included about 18 exahash of hardware, which was Bitmain S21 plus hydro miners, as well as the infrastructure, which is the containers. And in addition to that, we did about 100 megawatts of air-cooled. So it's heavy infrastructure. We own our own substation. We own our own land. So at its essence, it's a data center business. So you have kind of long tail assets on your balance sheet, which have a 20, 30-year economic life cycle. And then the ASICs, which is the most expensive part, the compute, you have to upgrade every 3 to 4 years. So the secret to Bitcoin mining, and we are the longest standing publicly traded Bitcoin miner in the industry. We lead the sector in having the best ROI. And the secret is having ROI. Because what happens is a lot of people get excited about crypto mining. They think it's exotic. They think that you can make a lot of money. But because your top line is very volatile, you have to understand how to mathematically model that volatility and how to mathematically deploy your capital and ensure that you get an ROI in about 1 to 1.5 years after cost, so that for the remainder of the 3 to 4 year cycle of those ASICs, you're actually free cash flowing. So for example, if you deploy $200 million of ASICs, in 3 to 4 years, you operate them and then they'll be obsolete. It's by design, it's just how the network works. So you have to make sure that you make back a lot more than $200 million in that 3 to 4 year horizon. And what happens is your ROI, your profit margins start quite high, and then they slowly shrink as time goes on because hash price commodifies. So for example, like just by show of hands, how many people in the audience are familiar with the concept of hash price, just by show of hands? Okay, not many people, but it's good that a few guys in here get it. So hash price is basically the dollar that the Bitcoin network pays per day for unit of compute. So right now, the network is paying just under $50,000 an exahash a day. So we have 22 exahash. So 22 times 50,000, we're earning about 1.1 million a day of revenue from the network. But of that revenue, we have many different types of ASICs that are operating. And so each ASIC has a different break even. So a brand new ASIC, an S21 plus Hydro, right now is operating with a profit margin of about 60%. An older generation ASIC, an S19J Pro, those came out 3 years ago, they're running at about a 25% profit margin. Eventually, in a year or two, the J Pro will become obsolete, probably at the next halving, right? And so you know this and you have to model it. So as long as you can understand and deploy, understand this volatility, deploy capital in, basically you buy when there's blood in the streets. The hardest time to expand in crypto mining is when markets are down, but that's the best time, right? Because ASIC prices are highly volatile. You want to buy ASICs when they've come down in price. So you have to have a strong treasury strategy. By the way, my executive team's here in the front row, so Tim helps me very closely with this. And you've got to buy ASICs when they're cheap. So we bought a large order for $14 a terahash. That was a 1 year ROI. and we'll be free cash flowing. And that's the business of mining. A lot of operators do go bankrupt. You saw in 2022, FTX went bankrupt, Celsius went bankrupt, but that triggered Core Scientific to go bankrupt and Argo to go bankrupt. So it can be perilous, but if you're mathematically attuned to the volatility, you can really flourish.
And Jeremy, staying on the Bitcoin mining side, how has the institutional interest changed in Bitcoin mining in the recent years? And what do you think, where are we heading in this space?
So yeah, to kind of understand where we're at and where we're going on the institutional side, you have to see where we were. So if you look 5 years ago, the only option of getting involved in Bitcoin mining was to get involved with the public miners, investing in public miners. Now with the big shift that we've seen, say over the last year and a half, 2 years, with ETFs being approved, Bitcoin becoming a true institutional asset that is being held at the highest levels now, we see now a shift from just holding Bitcoin to mining Bitcoin as well. And that's from the lower level all the way down up to the institutional level. And the way this works is most institutions are just now getting their mind around what Bitcoin is and why they should hold it and why they should invest in it. The logical next step, of course, is, okay, how do I get more Bitcoin? How do I hold more Bitcoin? And the cheapest way, as we know, as Bitcoin miners, is to mine Bitcoin, because you're going to get it at a cheaper price per Bitcoin long term, as long as you are efficiently mining Bitcoin. And we're starting to see that shift where institutions, Bitcoin treasury companies, they are starting to move on beyond just purchasing Bitcoin and getting more into, okay, let's start to mine Bitcoin. Let's partner with Bitcoin miners. Let's open up our own mining firm, or let's work with a company such as GoMining, who can provide that mining as a service and give them access to the yield coming from Bitcoin mining.
And Richard, coming back to the fund management side of it, Bitcoin historically has been criticized by traditional financial managers, asset managers, that it is too volatile in nature, which has improved quite a lot in the recent times, where we have seen, even in the recent dip that happened over the weekend, Bitcoin lost way lesser as compared to some of the other asset classes. Are fund managers these days well positioned to take advantage of this crypto volatility or Bitcoin volatility in specific?
The short answer is no, and I'll tell you why I think that's the case. Just going back a little bit, Bitcoin is often called digital gold. It's a slight misnomer, but there are some similarities in the way that Bitcoin and gold markets trade. The similarities are that there is a physical market and there is a paper market, derivatives, and it's not uncommon for the derivatives market to separate, for there to be a price discrepancy between the paper gold and the physical gold. And we're seeing that right now in silver markets. That discrepancy will also occur in Bitcoin. My good friends here mine Bitcoin. The principal difference between them and gold miners is that if there is a real demand for gold, we can go and mine more of it. There's plenty more gold under the ground. It's just expensive to get. But in a few years' time, no matter how clever these guys are, there's going to be no more Bitcoin. And if that coincides with there being a huge demand for Bitcoin for an inflation-proof asset or a political-proof asset, the disconnect between the Bitcoin price and the paper Bitcoin price will become essentially infinity. Now, right now, we started our business 2 years ago, and we used to get phone calls saying, well, you're new guys in Bitcoin, you're trading options, you're a bit weird, we'll try you with 50K and see how it goes. I'm now getting phone calls from hedge funds in the US who say, okay, our minimum ticket is $250 million. You're one of two teams that we can identify who can even fill in a DDQ. So how about taking some of our money? There is an avalanche of money about to enter the Bitcoin market, and it's going to cause a huge stress between the physical and the paper market. And I don't think anyone's prepared for that.
And one question to all of you. a lot has been discussed about the digital asset treasury company in recent months as well. We have seen a new wave of people launching. That's what they call it. In your opinion, what are your thoughts on this trend? A, and we can ask, like everyone can jump on this one. And secondly, how do we differentiate? Because if a company is holding, for example, strategy, they're holding Bitcoin, and there are 30 other companies holding the similar asset. How do you differentiate then among the digital asset treasury companies? We'll start with you, Richard.
Our experience is that the way you differentiate yourself is by not losing money. It's cryptocurrency asset management has evolved very quickly, and I'm by no means the most experienced guy on the panel here, but a few years ago, you could get away with making huge returns and taking big losses, and as long as your returns outweighed your losses, you'd survive as an asset manager because people expected volatility. That has changed. Now that Bitcoin is essentially has become an institutional investment asset, institutions are utterly intolerant of loss. And the only asset managers who will survive are the ones who can contain losses.
Jeremy?
Yeah, what we see from the treasury companies is not everybody's going to be able to duplicate the strategy that Strategy's doing with Michael Saylor. Everyone's trying to be the next strategy, but I don't think the majority of them are going to work out. If they're not careful with the risk management and they start to over leverage with the amount of Bitcoin that they're buying, we're going to see blow-ups. We're going to see another, FTX style blow up in the space because too many people are leveraging up. But that's not going to stop this direction. I think we're going to see multiple different directions kind of break out of this this big push to put Bitcoin on in the treasury. The first is going to be, of course, the MicroStrategy or the strategy gameplay where they're just going to continue to lever up and buy as much Bitcoin as possible. But then the majority of companies are just going to understand what Bitcoin actually is, which is the best saving asset that there is. And they're going to continue to just hold it on their treasury without having to worry about, okay, I'm going to do this especially to increase my stock price or, raise debt against or whatever. I'm just going to continue to hold Bitcoin because it's better than holding fiat. And then the third option you're going to have is you're going to have new treasury companies who are going to start to say, okay, I need to differentiate myself from other treasury companies. And in order to do that, I got to have a different strategy. So you're going to see companies that are trying to produce actual yield on their Bitcoin. We're already in discussions with multiple treasury companies about mining Bitcoin for the treasury because now they can get access to cheaper Bitcoin over time because all they care about is, okay, how can I increase my Bitcoin holdings? So I think it's going to break out into multiple different strategies over time. And, we're going to be there to partner with those type of companies. But I don't think everybody's going to be able to, everybody who thinks they're going to be able to be the next strategy, I don't think that's going to work out very well.
Aydin?
So, first and foremost, I'm a Bitcoiner and a HIVE. We're Bitcoin miners. So I think part of your question was looking at different digital assets relative to Bitcoin. I mean, it's been well said on this panel, but Bitcoin's, $2.2 trillion market cap. It's by and far the largest digital asset. It's an energy-backed currency. So Bitcoin has real value, right? Like Bitcoin is really ordained with physics. The input to the system is energy, joules of energy, and the output is hash rate, which mathematically converts to Bitcoin. And so that ratio is what changed with time. And obviously there's scarcity economics that are ingrained in Bitcoin through the white paper. But that proof of work, I've always been a proof of work guy. I mean, we used to be a big Ethereum miner. We were 6% of the network. We had 130,000 GPUs mining Ethereum. Proof of work is what gives digital assets a true cost to produce and true value. So that being said, I definitely and then when Ethereum went to proof of stake, we got out of that business, pivoted our GPUs to AI, but our mining business is firmly rooted in Bitcoin. So having said that, you look at all the big players, the institutions, and we got a couple really smart fund managers here. I think Bitcoin, without question, is the digital asset of choice as a store of value. Moreover, we had a balance sheet at the beginning of the year. We had 2,200 Bitcoin, so about $250 million of Bitcoin on our balance sheet, and we put that to work to scale our business. So we pledged, for example, $130 million of Bitcoin to expand our business in Paraguay. And when we made that pledge, Bitcoin was $87,000. So today Bitcoin is at 110, and we have an option to buy back those Bitcoin, those 1,300 Bitcoin at $87,000. So we're $40 million in the money on that trade, using our Bitcoin to finance the growth in our business. And usually when you think of financing options, there's a cost. It's like, what is your cost of interest, or is there any other fees in a structured finance? Because our counterparty in this deal believes in the value of Bitcoin. They said, give us your Bitcoin now. We're going to send you the ASICs, right? They sent us hundreds of millions of dollars worth of ASICs, and they said, you can either repay us with cash or keep the Bitcoin. Well, Bitcoin has obviously gone up, and so we're 40 million in the trade. So I think Bitcoin is a very powerful tool, and I think you were saying how, obviously with modern monetary theory and zero interest rate policy, there's just so much money printing happening globally. We've seen inflation since COVID, nation by nation, and just globally, like the cost of goods has gone up, incredibly. And I think we're just going to continue to see that, right? The US dollar is continually going to be printed, continually devalued. The deficit in the US and all countries, right? I mean, American capital markets are great, don't get me wrong, but I just think that modern monetary theory almost dictates that we're just going to see more and more monetary printing. And everybody's here at the blockchain conference because you believe the same thing. And so I think Bitcoin is definitely a good store of value long term. But I think with the layer twos, people can use it day to day more often for interactions, etc. We're not in the layer two business, but I think it's a very cool ecosystem. And I think that gives Bitcoin a more practical use case as well. So yeah, Bitcoin.
Michael?
Yeah, I guess to complement what you said and the other panelists, our opinion is that the regulation is now set up that we'll get new financial products coming in the next sort of 12 to 18 months. If you look at traditional Bitcoin miners and DATs, there's very few products for them to pick for to make yield on Bitcoin and to do it in a safe way. So we believe that is coming. And I think as a positive for the digital asset treasuries as well as the miners, they'll have the ability to have a menu of different options to be able to pick from, whether it be more unique setups like you described in financing, or having more plain vanilla bonds, options, yield type structures. And so I think that wasn't possible 12 months ago because of regulation. That's now possible. And so you're seeing a lot of building happening behind the scenes. We're seeing more in DeFi. As DeFi liquidity rises, we're seeing more in traditional finance. But I think net will be in a world come this conference next year where there's going to be really interesting products that are on the market to be able to provide a quasi or semi-protected yield on Bitcoin.
And Michael, staying with you, where do you see Bitcoin as an asset class in the next 5 years? And the reason I'm asking this by now, okay, we started with the retail side and retail investors started investing in this market, so people got to know about it. Now, almost every institution, they know about Bitcoin and what Bitcoin is. And we were talking about earlier in one of the panels as well that how corporate treasury people, they are thinking of adding Bitcoin just to diversify their treasuries as well. Where do you see Bitcoin as an asset class, as a fund manager, as an investor in the next 5 years?
Yeah, so I guess I'll make one comment. So Bitcoin is still not a practical asset when it comes to financial infrastructure. What I mean by that is we sit on a lot of Bitcoin. One of our backers was one of the original Bitcoin founders, and so I have hundreds of millions of dollars of Bitcoin in our balance sheet. To get leverage on that Bitcoin is quite expensive. So I can go out and borrow, Tether, dollar type assets, which we need to trade, but it costs me anywhere from 7 to 10%. That is a fairly high hurdle and a friction cost for us to be able to run our quant business. So to frame it, in traditional business, and if I hold treasuries, I can get leverage at 3%. Right now, it's 2x, 3x the cost. So what we're doing is working with the large banks and financial institutions around the world, whether it be New York, Singapore, Abu Dhabi, to try to get them comfortable to treat Bitcoin as a core asset. And that's part regulatory, part then just learning about Bitcoin, part the infrastructure, custody, etc. But I think everybody on this panel will benefit from Bitcoin being more accepted. And I do see that happening. It's just taking a long time.
Aydin?
One thing I think that is interesting to note right now in the US, the ETFs are valued at about $150 billion. The ETFs between like BlackRock and Vanguard and all the other Bitcoin spot ETFs. So $150 billion of ETFs is roughly 7% of Bitcoin's total market cap, which is pretty impressive. What's really interesting, though, is I was in New York a few weeks ago for a roundtable, and a wealth manager from Morgan Stanley was saying that, and they've got a huge network of retail brokers at Morgan Stanley, they can't actually recommend their clients to buy the Bitcoin ETF or the spot yet. So everybody that's buying the ETF is actually self-directed, which is pretty interesting. So like that's a lot of, so that's, you know, someone goes to their financial advisor and says, hey, I want Bitcoin, please go buy this for me, or they do it themselves on their Qtrade account or whatever. So I think that, which I didn't really realize, I'm based in Vancouver, Canada, by the way. And so I thought that was a really interesting nuance. So I think once the big institutions, like once BlackRock actually puts Bitcoin on their balance sheet as an institution, or once JP Morgan puts Bitcoin on their balance sheet, that will be a huge next wave of capital, because right now they just have these kind of derivatives, right, which is really like the spot ETF. When that happens, we'll see, I think, even more institutional capital come into the sector. Yeah, I hope I answered your questions. There's a lot of feedback noise, so yeah, I hope I answered it.
Jeremy?
Yeah, I have a little bit different view on just Bitcoin as an asset class and where it's going. Of course, on the institutional side, it's going to continue to have more and more adoption. It's going to be held at the corporate level, at the sovereign level, the state level in the U.S. We see that happening right now. But if we look at Bitcoin and its growth and where it's going, you know, we have to understand that when Satoshi created Bitcoin, he created it as a store of value, which we have. You know, that's your digital gold, but also as a medium of exchange, which we are still yet to reach, I believe, with Bitcoin. So I think, you know, with the start of the build out of the layer 2s of the BTC5 protocols on around Bitcoin, we're going to see a major build out of that over the next 5-10 years. And with that, you're going to see a lot of capital rush into Bitcoin on the DeFi side of things. A lot of the capital that's in these other chains are going to come back to Bitcoin because Bitcoin's the best underlying collateral that you can have. I think there's going to be major growth on that side. When it comes to Bitcoin mining, of course, that's going to help incentivize us miners as we start to see more and more transaction value being done on the blockchain, as we get through more halvings and the rewards are getting cut in half. And then I think the next, you know, Aydin can probably agree with me, the next 5-10 years are going to be amazing for Bitcoin miners. We're competing directly with AI HPC for every site that we try to open. They're willing to fork out more money for energy, and with that makes it harder for the network to grow hash rate wise, but we know where the price is going. So there's going to be a kind of arbitrage opportunity there for Bitcoin miners that I think we haven't seen in the past. And I think it's going to be an amazing next, 5-10 years for that.
Richard?
Yeah, I think I'm more aligned with Michael on this. I see Bitcoin becoming the same as any other very scarce asset, in that it becomes collateral and only collateral, and you only ever move your Bitcoin under pain of death. I think the market will be that Bitcoin will be stored in vaults and in custody, and will be borrowed against for liquidity. Because the risk of losing your Bitcoin in terms of your future inflation defense is way too high.
And one last question before we close this session. What we have seen recently, kind of correlation between Bitcoin and, for example, US indices and all the other stock markets. Do you see this correlation to continue as Bitcoin evolve as one of the leading asset classes in the financial world? We'll start with you, Richard.
Sorry, could you?
The correlation that we have seen recently between Bitcoin and, for example, S&P 500 or all the major financial indices. Do you see this correlation to continue?
No, we've seen I mean, we monitor the way that Bitcoin trades very closely. It's what we do, and there was a sea change immediately after Trump's election. So Bitcoin stopped trading like Bitcoin and started trading like Nasdaq. And right now, holding Bitcoin or holding Nasdaq index is the same trade. However, there will come a moment when holding Bitcoin will, in the next dislocation, and if it's a dislocation up, which I'm sure it will be, they will diverge in a most catastrophic way. And I think that this feeds into my concerns in my first answer, which is that fund managers and asset managers and traders on Wall Street currently see Bitcoin as a risky plaything. They have no idea of the importance of it in terms of defense against wanton money printing. And when they realize that, there's going to be a massive rush for Bitcoin, and you'll see the price accelerate away, like you're seeing in the gold markets at the moment, the silver markets. You'll see that times 10 in Bitcoin.
Jeremy?
Yeah, just real quick, I totally agree with everything that's shared here, but it's going to be step by step. It's going to be little by little. We're going to see it kind of look as a risk-on asset when it comes to investing, just like the Nasdaq. But then overnight, it's just going to diverse and take off, and everyone's going to be like, "Oh, why didn't I get a part of that?" Hey, we've been talking about it for years, and I think it's just going to be a certain moment where everyone realizes, okay, if you don't have Bitcoin, you're going to be left behind.
Yeah, I think what we've observed is that Bitcoin is tightly correlated to gold in terms of, its movement in the market. Administration policy in the U.S. has driven it a lot. Like the Biden administration, Gary Gensler was pretty anti-Bitcoin, so I'm super glad Gary Gensler's gone. He sucks. He's terrible. And look, the Trump administration, every crypto miner that's publicly traded saw a 52-week high when Trump got elected. So I think with the advent of that, and even Trump's sons have a Bitcoin mining promotion called American Bitcoin, the rails from a regulatory perspective are allowing, I think, Bitcoin to be more correlated to the markets generally, but I wouldn't say it's directly correlated to the S&P or the Dow. I would say it's more tightly correlated to the gold, but when interest rates are low and you don't get risk-free yield from bonds or whatever, then I think people do look at Bitcoin and just crypto in general as as sort of a better store of value. But moreover, I think when you saw the last all-time high was in 2021, it was kind of in the wake of COVID. It was showing that people were kind of losing faith in the financial system, and so you were seeing capital find its way into just the crypto ecosystem broadly. I think this bull market was really driven by the new Trump administration, and so that's exciting. But going forward, I think that just because of the implicit scarcity of Bitcoin, more and more people adopting it, more conferences like this where people are coming to learn about crypto as an ecosystem, and then I think like certain catalyst events, right, that will just drive further adoption. But in terms of correlation, yeah, I think it's really more almost like the opposite of the dollar, right? Like if you want to have a hedge against inflation, I think people more and more are going to see. I hope there's going to be less volatility of Bitcoin price as it becomes more and more institutionalized and recognized more and more as a store of value. But we'll have to wait another year to see how that theory plays out.
Yeah, Michael?
I guess maybe to support that, I think one of the nuances about digital assets or crypto in general is that they trade 24/7. So if you're going into the weekend and all of a sudden President Trump decides to kitchen sink and say he's going to 100% tariffs, crypto gets hit badly because it's still trading. Everything else is closed. So we foresee a world where most assets become tokenized and most assets trade 24/7. So when that happens, the emphasis on Bitcoin getting hit as a risk hedge, if you will diminish. And I think Bitcoin then becomes pure collateral. I do think right now you are seeing it get hurt, not because it's Bitcoin, just because it's easy for them to trade and use as an overnight hedge or weekend hedge.
Well, it was a lovely discussion. Thanks for your valuable insights, and thanks everyone for staying with us. Thank you so much.